We're going to spend 2 weeks on depreciation. This will be good news for some of you because we're going to spend 2 weeks on a very limited amount of material. So instead of the scattergun approach of 1 from here and 12 from there and 3 from over there, we're simply going to cover the rules for depreciation. The bad news for some of you is that this is definitely sequential learning. I have a depreciation packet. It starts with the checklist. You need to, not today, but by the time the 2 weeks are over, you need to be able to start at number 1 on the checklist, work your way sequentially through, understanding what each step means. And number 1 has to happen before number 2. If you do them out of order, you won't get the right answer. If you skip one, you won't get the right answer. So we're trading huge amounts of material to more meticulous learning of a set of materials. So before, if you didn't know how to do the kitty tax, it didn't hurt you outside of that question. Now, if you don't know how to do number 1 on the checklist, it will hurt you almost all the time. So it's very important to keep your eye on the ball. Keep your checklist with you at all times. They'll be handed out in class, depending on when you listen to these PowerPoints. They're also out on Blackboard. There's 12 pages. You can always print more copies if you need to. So what we're going to do is see the little thing at the bottom there. We are going to take our bases in the property, which is the amount of money that we spent. We're going to have a depreciation method. And like GAAP, we're talking about straight line, double declining balance. That's what I mean by method. And then we're going to have a modifying convention. What you will see is that these rules are very streamlined, very much one size fits all. A modifying convention is just a convention or rule that modifies the math. And in the real world, for GAAP, there's all sorts of different modifying conventions. For tax, we are forced to use the modifying conventions that are defined by the IRS, and there aren't very many of them, and we'll cover those rules in a little bit. So you will need a modifying convention in the year you acquire and in a year of early disposition. So that little black strip across there needs to be tattooed on your forehead or at least looked at because it's the very first thing on the checklist so that you know what you're doing each time. So this is just a snapshot of the checklist to make sure that everybody knows what I'm talking about. Steps 1 through 7. Today we're going to talk about 3, 4, 6, and 7. And then we'll pick up the rest of that as we go forward. So as we go through the rest of these slides, I've simply done a snapshot of number 3. We'll talk about it directly, and then we'll work some numbers, and we'll move our way through. So your goal for this week is 3, 4, 6, and 7. And then this is the chart that is about the second page in the packet. And you can think of this as your cliff notes, if you will, because all the pertinent things are summarized here for you. Now, back in the cliff notes for the solutions for Chapter 6, that's where depreciation is formally discussed in the textbook. There are also the cliff notes there where the book is going to summarize all these same rules. The book itself has about 15 pages in the middle of Chapter 6 that are dedicated to this topic. You should also have your instructions for your 4562 and your How to Depreciate publication from the IRS. If you ordered all of that material, you've got lots of reference material, and you should be able to look up things as you go. But your first stop could always be the checklist and this chart, because you might be able to get a quick answer just by going here first. But remember, just like PowerPoints are not the be-all and end-all of life, sometimes you will have to break down and look it up in the IRS publications. So let's look at the first few columns of the chart just to get a quick overview of these topics. Some of them are discussed in more detail as we go through the PowerPoints. First, notice that the chart is divided into 3 sections: equipment, commercial real estate, and residential real estate. Each one of these you want to think of as a block topic because their rules are going to be a little bit different. In the very first column, bases, We're not going to spend a lot of time with basis in this material. On the last part of the course, we're going to do a lot of buying and selling of property, and we'll spend a lot of time there. I will simply tell you that we spend X dollars. If it is land and a building, you will have to pull the building and land into two separate pieces, because we do not depreciate land for tax any more than we depreciate land for book. So read those couple of notes, 3 notes. And then the next column says salvage value. We do not have such a thing in tax anymore. We depreciate down to the very last penny. So you will not be having to put aside the salvage value and making sure you don't depreciate it past it. Useful lives. We've got some slides coming up to discuss those. We are predominantly just going to use 5- and 7-year life properties. Note that you don't have a choice here. You must use these categories. At the back of, I believe it's the Pub 946, How to Depreciate Property, there are about 15 pages dedicated to describing all the different ways you could use a truck. And invariably, that answer is going to be, regardless of how you're using it, it will have a recovery period of 3 years. Most equipment will have a recovery period of 7 years. So RP is recovery period. That is what we will be primarily using as our useful life or recovery period. When we open up number 1 on the checklist and we have to slow it down, we will use the class life. So you can note that for certain properties, we could use 3 years or 5 years, and we can't use anything else. So there's things like old racehorses and breeding pigs in that category. We don't use a lot of it. The category with the recovery period of 5 years, your cars, your trucks, a lot of your office equipment will be there. And then the workhorse category is category 7-year recovery period. And I would guess that maybe 90+% of all equipment falls into that category. And the note says that you don't have to figure that out. I will always tell you what the recovery period is. If you need the class life, I will tell you that too. And if you drop down to the commercial real estate, you will see that our choices are a whopping 39 years or 40. If you had really old property that you purchased prior to 93, you would recover under 31.5 years. But they needed more money in 93, so they decided that buildings were being recovered way too fast. And one way to generate more revenue was going forward to increase their recovery period to a full 39 years. And then residential real estate, we've got a slide for that, but the short story is homes and apartments qualify as residential real estate. Hotels are commercial real estate. So if you are renting a home or an apartment out to the public, you can recover over 27.5 years. Or if you want to slow it down, you have that choice of 40 years. On the last slide, I neglected to mention that equipment can use 200%, 150%, or straight line depreciation, and buildings can only use straight line depreciation. But we have more slides coming to talk about all of that at length. I'm going to be referring to IRS tables, so I wanted you to get a picture of that too. It's also in your packet. Because double declining balance is fairly complicated math, and the IRS is convinced that normal people don't do math very well, it goes out of its way to give help aids which will make the math simpler. So when you're using the IRS tables, this particular page, you're using double declining balance for 5-year and 7-year property, and 150% for 15-year property. And instead of the work, a drudgery that you do in GAAP, where you calculate depreciation, decline the balance, calculate depreciation, decline the balance, the IRS has cleverly invented, let's just decline the percentage. So when you're using these tables, if you spend $1 million on equipment, you will always use $1 million as your basis, and you will simply pick up your percentages from this table. Inquiring minds who want to understand where these numbers are coming from, on page 4 of your checklist, on the other side of this page, are some explanations of the math, how you get to 20% for the first year when it's 5-year property, half-year convention. and how you do 35% when it's mid-quarter convention. And we're going to define half-year and mid-quarter conventions in a little bit. I'm just making sure that you know what the table looks like so you know what I'm referring to. All right, so what we have here is just a big old glump that simply says that when you buy something that will benefit the company for more than one tax year, you cannot take an immediate deduction for most things. So we're going to be buying equipment, buying buildings, and we're going to be recovering them using depreciation. We're going to be using MACRS depreciation, which is the rule that's been in effect since 1987. You will not be tested on any prior year's depreciation. So we got personal property and real property. Personal property is equipment, and there's a slide about the different lives on the next side. And do differentiate personal property from personal use property, which we will be talking about as we finish up the rest of the material for this module. Personal property has several lives. We will be focusing on 5-year, 7-year, and 15-year. Those are the 3 lives that you have tables for in your handout. Real property, the 27.5 is residential. That's apartments and rental homes. Everything else is 39 years, other than the stuff relating to railroads, which we're just not going to even discuss at all. All right, depreciation methods. First of all, remember salvage value is ignored for MACRS, and you want to make your life easy and use the tables, especially for non-buildings, because they are using double declining balance. We're going to be using PIG rules, which means that you're going to get the biggest possible deduction. So with the properties listed here, that will be double declining balance. Eventually, we will open up number 1 on the checklist, and you will learn about one set of facts that would force you to use straight line. 150% would apply to 15 and 20-year class. Remember, I can ask you about 15-year property because we have a table for it. And then straight line is what you use for all buildings, whether they're residential with 27.5 years or non-residential using 39 years. Remember, you have your cliff notes. Non-residential property placed in service way back in the dates on the checklist I was actually using a 31.5-year life. So never ignore the bold. If I have a date placed in service that's bolded, I'm telling you to think so that you get to the right answer. The next slide discusses A and B of number 3 on your checklist. All you really need to know about C is that we are currently using the 50% rule that was in place from January 1, 2012 through December 31, 2013. And the provision is, at least as far as we know today, expired going forward. As you can see, the provision had a lot of different ramifications, the different variations. You might notice that the very first time that bonus depreciation was used was right after 9/11. And it wasn't passed on 9/11 or prior to that. It was actually passed fairly late in the year 2001. But the economy was going into a recession before the towers went down, and then we just continued to spiral after that. So your government was desperate to find different ways to stimulate the economy. And so there had been a form of this bonus depreciation in the 1990s. They brought it back and made it a 30% reduction. It worked well, but that recession took a long time to get rid of, so they raised it up to 50. They let it expire for a while, and then 2008 should remind you that was another time where life was not so good. So they put it back into play, and this last recession has just taken a really long time for us to get some sort of meaningful recovery. So they kept extending it, and for more than a year, you actually could write off all of the cost of your equipment. So for about 14 months or so, nobody had to depreciate any kind of equipment. You could just expense all or bonus depreciation, all of it, and be done with it. So those were nice days. All right, bonus depreciation, officially called additional first-year depreciation, but most of us just call it bonus depreciation because there used to be another version of this that was called bonus depreciation. So for the year 2013, which is our money shot, you get to deduct 50% of the cost if you meet certain requirements after limited expenses. Now that's number 2 on the checklist. Don't worry about it. We will cover it next week. This entire provision is currently scheduled to have expired. It does not exist in 2014, but we have had them introduce the provision retroactively before. So we never tell anyone to write it off completely. No, make your acquisition decisions based on the hope that it will come. You should always make your acquisitions on sound business foundations. And if it comes, it's just a nice surprise, right? And in our current political environment, it's not clear that we'll ever have any tax legislation, no matter how much we might need it. So it must be new property. If I don't tell you the property is used, it's new. You got to be careful here, right? Because sometimes I say you have property used in your trade or business. That's not defining the quality of the property, right? So you need the word used or secondhand in front of the word property, right? Used property is placed in service, is used in your business. And so you simply need to make sure you stop and read carefully. If I don't use the word, if there's no the modifier in front of the word property, then it is new property, right? You're not going to second guess me. We have one solid rule. If I don't say it is used or secondhand, it is new. MACRS recovery period has to be less than 20 years, or software or qualified leasehold property. And I wouldn't worry about either of those. The qualified leasehold property disappears after the end of 2013. And there's just some special rules for software that we just don't have the time or energy to get into. Qualified business use must be greater than 50%. We will discuss that when we get to number 1 on the checklist. If there is no percentage in the problem, then you are going to use the fact that qualified business use is 100% and no adjustments are required. As much as I'm sure you love doing tax returns 6 and 7, you will be glad to know that tax returns 7 and 8 each consist of completing one page, the depreciation and amortization form 4562. This is the front page. I will be doing excerpts of it and discussing our calculations in reference to this form. But once again, I wanted you to see the whole picture, make sure that we're all talking about the same thing. So when you do your Mickey and Jackie, tax returns 8 and 9, you will just be completing the appropriate parts of this form. And for Mickey, just in case you missed it in class, all you're going to do is part 2 and part 3 and line 22. Line 22 is the total. I'm always asking for the total depreciation available. We're using the PIG rules, right? That means if you can do double declining, you're going to do double declining. If you can do any of the fancy stuff we're going to talk about, you're going to do it so that you get the biggest possible deduction. So completely ignore part 1 for tax return 8 for Mickey and for these slides. So we're going to talk about 2, bonus depreciation is part 2. So we're going to go to a cleaner picture of it and talk some more about bonus depreciation. So this is just part 2. So there's lines 14, 15, and 16. We're only going to use line 14. So what I'm referring to as the bonus depreciation is officially in the tax code called the special depreciation allowance. All right, so you can deduct 50% off the top of all your new property if their life is less than 20 years. So no buildings here, right? Buildings do not get anything other than straight line depreciation. Nothing fancy at all for your buildings. So once you've determined whether or not any of your property is entitled to the bonus depreciation, you will write it down on line 14. And then the very last thing that part 3 of the checklist tells you is to reduce your bases before going on. Do not forget to reduce your bases before going on. This is just the excerpt from the chart. It really doesn't add anything that we haven't already said, just reminding you that it is there as a reference if you need to look up something quick, and to remind you that there is no bonus depreciation for any kind of building. And once you finish number 3 on the checklist, it's time to move to number 4. There are some slides coming up talking about this in more detail. Remember that we must have a modifying convention in the year of acquisition and in a year with an early disposition. The modifying convention is built into row 1 of all tables. So if you're using a table, you only need to pick up the percentage. You do not need to make the extra math. And I'll say that several times. The test for mid-quarter is going to take the fourth quarter acquisitions and divide by total acquisitions for the year. To keep our life simple, we're always going to be calendar year taxpayers. So our fourth quarter will always be October, November, and December. So we've got examples coming up. We'll do this on the easy side this time and more elaborate examples when we do depreciation for part 2. Just a reminder that the notes are on the chart, and so it reviews the rules for you. When you're dealing with equipment, you test for mid-quarter, you run the math, and if it is not mid-quarter, if you did not place more than 40% in, then it will be mid-year. But your first test is to see whether or not you meet the fourth quarter rule before you determine that it might be mid-year. Our fourth quarter will always be October, November, December. Do not include buildings in your test for mid-quarter. They always use the half-month convention. So you get a half a month for the month you place it in service. And there are mathematical examples coming up. Modifying convention. This is just an adjustment to your first year and your year of disposition. That is a one-size-fits-all. So for buildings, it's going to be a mid-month convention, which means you lose 1/2 a month of depreciation in the year you place in service, and you lose 1/2 a month in the year of a disposition. So here's an example. We bought a residential building, was acquired in March. When you are buying things, you count towards December because you still own them on the last day of the year. So from March to December is 12 months. Subtract a half because you always lose a half. Divide by what? Well, how many months are there in a year? 12. So you divide by 12. Example 2, and the difference between example 1, the major one is residential building in example 1. So you would be using 27.5 years. A non-residential building, you'd be using 39 years, but the modifying conventions are calculated exactly the same. All right, this time it was sold. So we are going to have to adjust the table or our hand calculation. We count towards January because we sold it, so there's nothing in December. There's nothing to look towards in December, so we count backward. So July is the 7th month, and I encourage fingers here. Don't let your brain guess, because your brain will guess 6 rather than 7. You lose a half because you always lose a half. Divide by 12 because it's a mid-month convention, and there are 12 months in a year. All right, so we're going to start doing some actual calculations shortly. But before we do that, I wanted to draw your attention to part 3 of our Form 4562. By the time you get here, you will have decided whether or not you could use number 2 on the checklist, limited expensing, subject for next week. If you have taken any limited expensing, you've reduced your basis, and then you moved on to number 3 to determine whether or not you can take bonus depreciation. If you can, 50% goes on line 14, and you would again reduce your basis before we get here. So in that column C that says basis for depreciation, if it was equipment, it would be only what was left once you took care of number 2 and 3 on the checklist. For buildings, it would be the cost of the building adjusted by the land, because that's all buildings get. They don't get any special things. Okay? So a couple things to notice as we look at our buildings, because we want to be on H and I for now. When it comes to buildings, each building is going to get depreciated separately. So if you have more than one building, you actually have to put in the month and year placed in service. That area is pinked out above for equipment for reasons that we'll talk about later. So the day and month, the basis would be the dollar amount reduced by the land. And then notice that you have no choices for recovery period. All right, you are going to use the 27.5 for residential property. Use 39 years for non-residential. You are going to use a mid-month convention, and you're going to use a straight line depreciation. And whatever 25-year property is, we're not going to go there, so you can ignore it. We will have residential, apartment houses, and rental homes. And we will have non-residential real property, which will be everything else. Warehouses and office buildings, those kinds of things. So this is a good place to go when you're doing a calculation. If you're a little queasy about a modifying convention or a method for buildings, well, it can't be any simpler than just to look at what's here. Buildings use straight line mid-month convention over either 27.5 or 39 years. So here's an example. Corporation purchase an office building. That'll be non-residential. I won't always give you that hint. On May 1st, 2013, I will always give you the total purchase price and tell you how much of that was allocated to the land. The next sentence here, the building's salvage value was estimated to be $50,000, is a red herring, right? Because we ignore salvage value when we are doing MACRS depreciation. So it's your job to determine the basis, determine the method, and the method will be the life divided by with straight line or double declining or 150%. The modifying convention, well, because it's a building, it'll be a mid-month convention. All right, same set of facts. The answer is 3045. Hopefully you stopped and you calculated that. If not, do so before I show the answer so you know what's going on. If all you're doing is reading, your brain is not fully involved here. So the basis, well, it's the total purchase price minus the land cost. The method, straight line, non-residential, so you know how many years that is. If not, you simply look it up. And you need a mid-month convention because it's a building. So that gives you 190,000 as the basis. 1 over 39, here I've used the dividing sign rather than the slash that I'm using on the board. 8 months because May to December is 8 months. You lose a half because you always lose a half. Divide by 12 because there's 12 months in the year. All right, here's a second example. 2 years ago, you purchased an apartment complex. That's residential. Apartments and rental homes are residential. Spent $250,000. $50,000 was allocated to the underlying land. What is the corporation's allowable depreciation deduction for the year? All right. So the only thing that's changing here is it is residential. So you use a different life. Corporation's allowable depreciation deduction for the current year. Do you need a modifying convention? And the answer is, it depends. Did I tell you you bought it or sold it in the current year? If I did, then you need a modifying convention. So what's the answer here? Did we buy, did we sell, or did we hold it the whole year? All right, so think about the calculations. And I'm going to switch to the next slide. Same facts. This time the answer is 7273. Take a couple of minutes if you need to. And make sure you know what the basis is. You know what the method is. And did you need a modifying convention? What did you decide on the prior slide? All right, basis should be 200. The life, it's residential, so it's straight line over 27.5 years. Do not need a modifying convention because it's neither year 1 nor the year it was sold.